Hey guys, welcome back to the channel. Fun fact, on average, Americans will change jobs every 4.2 years. What does this mean? Potentially over your lifetime, you could have between 12 and 15 jobs. And if you take jobs with companies that offer 401ks, an increasing question that people have is, what do I do with my old company's 401ks? In total, you have 4 options available to you. And in this video, we're going to cover what I think is your worst option to your best option. So stick around through the end of the video. Number 1 is cash it out. Number 2, leave it where it is. Number 3, roll it to your current employer's 401k plan. And 4, roll it into a personal IRA. Let's start with the worst one, cash it out. Now, why would you do this? Well, perhaps it's just a very small amount, maybe a couple $1,000s, and to you, it's not really worth the hassle of rolling it over. So if you just want to get a check and then pay the taxes, you can do that. However, be aware that the taxes can be significant. One, you're going to pay your ordinary income tax for cashing out a 401k. It's like earning additional income for that tax year. Plus, you're going to pay a 10% penalty. Plus, your old employer is going to have to withhold 20% of whatever you're cashing out and give that to the IRS now because they know that, this could be a significant amount of money and you might not be able to pay it when your tax bill is due next year. And I like doing numbers examples, so let's assume that your gross income is $62,000. You take the standard deduction and that's it, so your taxable income is $50,000. If you go on the 1040 table and look up how much you would owe, your federal tax owed would be $6,864. But what if you have an old 401k that's worth about $20,000, and for whatever reason you decide to cash it out? Well, you're going to pay a 10% penalty, so that's $2,000, in addition to federal income tax on that money. Now, anything above 50, you're in the 22% tax bracket, so that's $4,400. So if you were to cash out a 401k with these numbers, you would pay an additional $6,400 this year, in addition to your original tax bill, which would be $6,864. So a total of like $13,200. It's just not worth it, in my opinion, to incur such a high tax penalty for what should be your retirement savings. And of course, there is always the opportunity cost, because if you cash it out, you're likely to just spend it. Now, of course, life happens. If you have urgent costs you need to cover, it's your money, you got to do what you got to do. But unless it's a serious personal situation, this should be money that you need to give time to grow in a tax-advantaged account so that you can retire comfortably when you turn 60. Your second option for an old 401k is to leave it there. Why would you do this? Well, if you're already in a plan you like, perhaps you're partnered with Vanguard, Fidelity, or Schwab in your old company's 401k. If you know that the fund options are good and the expense and fees are low, then you can just always keep it where it is. When you go to retire at age 60, you can start withdrawing money from those accounts. Perfectly fine. However, your old 401k plan might be terrible. If you cannot tell me what the expense ratios and fees for your old 401k plan are, then it's probably a bad 401k. I'm not going to name any companies on my channel that I think are basically fleecing people with excessive fees, 12B1 fees, audit fees, asset fees, admin fees, management fees, and of course commissions. In addition to having bad fund options, there are lots of 401k providers that will steer people into actively managed funds with expense ratios of greater than 1%. Definitely, if you're in a terrible old 401k plan, get that money out because you are losing money. Another concern with leaving money in an old 401k is what happens if that company goes bankrupt or disappears. There are lots of people with old 401ks at Enron, Sears, Blockbusters, Radio Shack. I honestly don't know what they're doing now. It is also just kind of odd contacting your old employer's HR department to ask questions about distributions or whatever. So the sooner that you can just get it out of that old company and move it to your current company or something, in my opinion, the better. Now there is something I want to note real quick. If your old 401k provider was paying you in company stock, generally I don't like this because what if the company is Enron or Blockbuster? But there are people in their 401ks who are paid in company stock. And if you do roll it over to a different account, there's something called taxation of net unrealized appreciation. And basically this lets you pay ordinary income tax on just your cost basis for the stock, and then you can pay more favorable long-term capital gains on the growth of that stock. This goes beyond the scope of this video. Contact a tax professional if this situation applies to you. 99% of people watching this video probably not. I just wanted to mention it. Your third option is to roll the balance of your old 401k into your current employer's 401k plan. This is free. This happens all the time, so HR departments are very used to it. And you should only do this if your current 401k plan is a good one. It has good investment options for you and low fees and expense ratios. So once again, if your current employer is either partnered with Vanguard, Fidelity, or Schwab, I'll give the thumbs up. And all you have to do is contact the HR department of your old company and say, hey, I would like to roll over my 401k to my new employer. This is the HR department of my new employer. They're probably going to have a distribution or a simple rollover form that you have to fill out, but the transition is pretty common and pretty seamless. A serious advantage to doing this, to making sure that all of the funds you have in old 401ks are in your current employer's 401k, is something called the Rule of 55. Because after the age of 55, it's really hard finding a new job or starting in a new career field, the IRS has allowed for this kind of loophole in retirement accounts, where if you are let go or fired or you leave your job after the age of 55, then you're actually allowed to withdraw from that company's 401k without penalty. You're still paying ordinary income tax like you would in retirement. However, you don't have to pay the 10% penalty. And this is only available for the 401k plan of the company you left after the age of 55. So if you have significant amount of money in old 401k plans, you wouldn't be able to tap that then until 59 and a half. Your fourth option is to roll your old 401k into a personal individual retirement account. What are the pros of this? Well, congrats, you have complete control over how you invest your money for your retirement. What are the cons? Congrats, you have complete control. All the responsibility is on you to manage your money and to secure your own retirement. Now, of course, on this channel, I promote financial literacy and I want people to educate themselves and to take control of their personal finances. I don't think it's that hard to research, what is a low-cost index fund that I can just buy and hold until I retire. That for most people is the best investment strategy, low fees, broad diversification. And if you want to partner with either Schwab, Fidelity, or Vanguard, I don't have any referral links for you. I'm not getting paid to push them on my channel. I just think there are reliable banks, trustworthy banks. If you go on Schwab's website, there's a phone number right there. If you want to talk to a representative, they can walk you through the process of rolling over a 401k into an IRA with them. Same thing with Vanguard, they want you to call them. Same thing with Fidelity. They have articles and videos you can watch if you want to learn more on your own about the 401k rollover process. And these banks really want your business. They know if they can get you as a customer today with a retirement account, then you're most likely going to be banking with them for the rest of your life. So they will walk you through the process. They will waive any fees. They will follow up with you with phone calls because they really want you to partner with them for life. Now, when rolling over money from a 401k to an IRA, you have to take into consideration if it's traditional or Roth. This simply means for tax purposes. For traditional side contributions, you got a tax savings that year and you're agreeing to pay taxes in the future. For Roth, you didn't get any tax savings when you made a contribution, but you can pull the growth and principal back out in the future 100% tax-free. Most company 401ks are traditional because the company doesn't want to pay the taxes on the contribution. But there are some companies that offer Roth 401ks. They're better in my opinion, generally. So when you roll these over, it goes from traditional to traditional, Roth to Roth. And how this works is when the rollover occurs, you're going to be issued a 1099. This is a income distribution amount that the IRS will now be aware of. You then, when you deposit it into your new bank's IRA, your new bank will issue a 5498 form. Basically, a rollover occurred into a tax-advantaged account. So if those two numbers match, then you won't have any tax difference this year for doing the rollover. Generally, your old bank is just going to ask you what is the name on the IRA accounts, what's the account number, what's the mailing address. If you can get your HR department to mail this check directly to your new IRA bank, that is preferable. Sometimes old HR departments won't do this and they will send you the check. Now this is really important. If you are mailed a check for a IRA rollover, you have 60 days to get that money deposited into your new account. If you don't do this, then the IRS is not going to recognize the contribution and you're going to have to pay taxes on the rollover distribution. They're basically going to treat it like you cashed out. So once again, you can find YouTube videos of the horror stories. Definitely, if you get this check in the mail, take it serious, get right on it, mail it to your new IRA bank because within 60 days, if it's not deposited, you're going to owe a lot of taxes this year. Now with traditional 401ks, people ask me all the time, well, can I roll over money in my traditional 401k to either a Roth 401k or a Roth IRA? People know that when you take the money out in the future, you're not paying taxes on it, so Roth seems pretty good. You actually can't do this. The government doesn't allow it. However, there is something called a Roth IRA conversion process, or sometimes called a Backdoor Roth IRA. So if you do have a 401k that you roll over to a traditional IRA, there is a process to transferring that money to your Roth IRA. I haven't made a video about the Backdoor Roth IRA or Roth IRA conversions. If there's interest, I will make this video in the future. So there you have it, guys, with old 401ks. Depending on your individual circumstance, it could vary. However, generally, what would I recommend? I would recommend that you roll over the old funds into a personal IRA and then just manage the money yourself. Once again, you have complete control, so the responsibility is on you. If you're looking for low-cost, simple S&P 500 index funds, these are the mutual fund versus ETF options with these three banks. These are the three banks I always talk about and recommend. And there you have it. Those are your four options from what I consider not so good to the best. Is what it is. Okay guys, if you enjoyed this video, give me a thumbs up so the algorithm knows it's good. In addition, consider subscribing to my channel if you haven't already. I talk about finance and investing issues. And if you have any comments or questions, I'll do my best to help you guys if I can. And until the next video, take care.